morning, ladies and gentlemen, and thank you for standing by. Welcome to the Wingstop Inc. Fiscal Fourth Quarter 2020 Earnings Conference Call. Please note that this conference is being recorded today, Wednesday, February 17th, 2021. On the call, we have Charlie Morrison, Chairman and Chief Executive Officer, and Michael Skipworth, Executive Vice President and Chief Financial Officer. I would now like to turn the conference over to Michael. Please go ahead.
Thank you and welcome. Everyone should have access to our fiscal fourth quarter and full year 2020 earnings release. A copy is posted under the Investor Relations tab on our website at ir.wingstop.com. Our discussion today includes forward-looking statements. These statements are not guarantees of future performance and are subject to numerous risks and uncertainties that could cause our actual results to differ materially from what we currently expect. Our SEC filings describe various risks that could affect our future operating results and financial condition. We use certain non-GAAP financial measures that we believe can be useful in evaluating our performance. Presentation of such information should not be considered in isolation or as a substitute for results prepared in accordance with GAAP. Reconciliations to comparable GAAP measures are contained in our earnings release. Lastly, for the Q&A session, we ask that you please each keep to one question and a follow-up to allow as many participants as possible to ask a question. With that, I'd like to turn the call over to Charlie.
Thank you, Michael, and good morning, everyone. We appreciate you joining us for our call this morning and hope everyone is safe and well. As I reflect back on the unprecedented year of 2020, it was clearly challenging for us all, but has also underscored the resiliency of the Wingstop brand and given us confidence that our growth strategies will enable our long-term vision of becoming a top 10 global restaurant brand. I'm extremely grateful for our team members, our brand partners, and supplier partners, and their commitment to the success of the brand and living our mission to serve the world flavor. Our growth strategy is predicated on expanding our global footprint, and despite the challenging backdrop of the COVID-19 pandemic, we opened 153 net new restaurants in 2020, including a record 59 new openings in the fourth quarter alone. Our brand partners are eager to build more Wingstop restaurants as a result of our best-in-class unit economics. Our domestic restaurants have achieved an average unit volume of $1.5 million, up from $1.25 million just a year ago. With an average initial investment of $400,000, our brand partners can enjoy cash-on-cash returns approaching 70%. As we close the year, our domestic development agreement pipeline hit an all-time high with more than 700 restaurant commitments at the end of 2020. This compares to a prior record pipeline of agreements at the end of 2019 totaling 610 restaurant commitments. Those commitments for new openings are primarily spread across the coming 3 to 4 years. Thus, we remain confident in our ability to deliver against our 3 to 5 year development growth target of 10% plus unit growth and believe that the current 2021 outlook will be slightly above that target and in line with current consensus estimates. 2020 also marked our 17th consecutive year of positive same-store sales growth, closing the year at 21.4%. On a 2-year basis, that equates to 32.5% same-store growth. Our strong top-line growth, coupled with our restaurant expansion, led to system sales of approximately $2 billion, an exciting inflection point for Wingstop. Another milestone achieved in 2020 was our ability to exceed $1 billion in annual system-wide digital sales. Our digital business represented about 40% of total restaurant sales at the start of the year and has now grown to more than 60% of sales and has sustained above this level the last 3 quarters, pointing to the stickiness amongst our new digital guests. As a reminder, 2020 also represented our first year introducing delivery system-wide as a new channel and now represents more than 25% of total sales, which has nearly doubled after only 1 year. Guests that use us for delivery are typically new to our brand, representing a great growth opportunity for the future. In 2020, our database of digital users has now expanded to more than 20 million guests. While 2020 was a record year for top-line growth for the brand, we believe there are a number of levers for us to pull to continue to drive long-term sustainable growth and deliver on our 3 to 5 year target of mid-single-digit domestic same-store sales growth. The 20 million guests in our digital database, driven by our continued growth in our delivery channel, will fuel our CRM engagement efforts as a key lever. Our personalized one-to-one marketing will play a bigger role to quickly generate repeat orders from the increasing number of new digital guests, as well as continue to increase frequency amongst our core fans. We won't stop there. Our national advertising strategy is working, and we continue to have a significant opportunity to close the gap to other top 10 brands in brand awareness and consideration. In 2021, we will leverage our system sales growth of nearly 30% achieved in 2020 and carry a multi-million-dollar surplus of advertising funds and utilize them to pull all these growth levers, including an aggressive strategy to lap our strong second and third quarter 2020 results with premium placed ads in places we know people will be watching, notably live sports. We believe we are well positioned to lap our remarkable 2020 results with continued domestic same-store sales growth. I'd like to provide an update on our international operations. As with most global restaurant brands, the impact the pandemic has had on international operations is greater than what we've seen in the U.S., particularly since a majority of our international restaurants had a higher concentration of dining room sales. However, we are encouraged by how our brand partners have been able to weather the storm the past year, and we will continue to support them as they emerge from this difficult operating environment. Despite the challenging circumstances, we still opened 25 net new restaurants across 5 countries and had only 1 closure. An amazing result indeed. We believe our international partners will emerge from this pandemic in a position of strength as we continue to invest in our international business and execute against our global strategy. While 2020 was a record year for Wingstop on so many fronts, I am really moved by the resiliency and momentum in the brand as we continue to build Wingstop into a top 10 global brand. We will continue to make the necessary investments in people, technology, and our restaurants to grow the brand and maximize shareholder value. We remain confident in our strategic plans that will continue to reward our shareholders, brand partners, and team members. And with that, I'll turn the call over to Michael.
Thank you, Charlie. As Charlie mentioned, 2020 demonstrated the strength and resiliency of our model and positions us well for 2021 and beyond. 2020 marked a year of record top-line growth for the brand. Domestic same-store sales grew by 18.2% in the fourth quarter and 21.4% for the full year, which is a 32.5% comp growth on a 2-year basis. Record same-store sales growth combined with 153 net new restaurants resulted in approximately $2 billion in system sales for 2020, up 28.8% from $1.5 billion in 2019. The 153 net new restaurant openings, which includes 59 net new restaurants in the fourth quarter, a record quarter for us, resulted in a global footprint of 1,538 restaurants. We are excited by our brand partners' strong interest to build and operate more Wingstop restaurants and believe we have the right foundation and drivers to execute against our long-term target of 6,000 plus global restaurants. Royalties, franchise fees, and other revenue increased $4.1 million to $28 million for the fourth quarter from $23.9 million in the prior year. The increase was primarily due to domestic same-store sales growth of 18.2%, as well as 152 net franchise restaurant openings since December 28, 2019, partially offset by a decrease in contributions received for our brand partner convention in the fourth quarter of 2019. We did not hold a convention in 2020. In the fourth quarter, our company-owned restaurant sales increased $1.8 million to $15.9 million from $14.1 million a year ago, mainly driven by same-store sales growth of 10.4%. Cost of sales as a percentage of company-owned restaurant sales increased by 250 basis points compared to the fourth quarter last year, primarily driven by a 27% year-over-year increase in the Urner Barry cost of bone-in wings. Our wing price mitigation strategy is in place with our largest poultry suppliers during this near-term pressure and has effectively lowered the cost of wings relative to full implied market value. The increase in cost of goods was partially offset by the leverage gained on labor and other operating expenses due to the growth in average unit volumes. While this is a short-term pressure on cost of goods, we are pleased with the improvements we saw in labor and other operating expenses, underscoring our efficient restaurant operations and our ability to secure competitive rates for delivery. At Q4 margins, we believe our brand partners benefit from best-in-class cash-on-cash returns of north of 50%. Reported selling, general, and administrative expenses increased $3.1 million to $21 million from $17.8 million in the fiscal fourth quarter of the prior year due to $1.4 million in higher professional fees, primarily related to opportunistic investments in technology and international projects to advance our global strategies. $1.3 million of expenses related to COVID-19 and continued support provided to international brand partners as certain markets reinstated restrictions as they work to contain the spread of the virus. $2.1 million in investments in people-related expenses associated with higher variable-based compensation expense, inclusive of additional stock-based compensation expense due to the company's results in 2020. These increases were partially offset by a decrease of $1.8 million related to the brand partner convention we held in the fourth quarter of 2019. Reported SG&A was $69 million for the year, which excludes the gain on sale of $3.2 million from the refranchising of 7 company-owned restaurants. Due to its materiality, this gain was recorded in its own line in the P&L and is not included in SG&A. Adjusted for this reclass, our prior SG&A guidance would have been $66.7 to $67.7 million. Full-year SG&A, as reported, was $1.3 million above this adjusted guidance as we made opportunistic investments in technology and international as we continue to advance our long-term growth strategy. We believe these investments support the long-term growth of the brand and achieving our goal of 6,000 plus global restaurants. Adjusted EBITDA, a non-GAAP measure, was $16.2 million for the fourth quarter, representing a 14.7% increase versus the fourth quarter of 2019. As we had previously communicated, we completed the refinancing of our securitized financing facility in the fourth quarter and recorded loss on debt extinguishment of $13.7 million. As a reminder, the non-recurring loss on debt extinguishment is excluded from our adjusted EBITDA, adjusted net income, and adjusted EPS calculations. Despite the transaction closing late in the year, an increase in our total indebtedness by $153.8 million versus the third fiscal quarter of 2020, we saw lower interest expense in the fiscal year 2020 versus 2019 thanks to the more favorable debt terms of this facility, which carries an interest rate of 2.84% compared to the prior rate of 4.97%, and will translate to approximately $2 million in annual interest expense savings. As a result of $13.8 million of expense associated with the refinancing of our debt and related payment of a special dividend in the fourth quarter, we reported a net loss of $6.4 million, or a loss of 21 cents per diluted share. Adjusted net income and adjusted earnings per diluted share, both non-GAAP measures, were $5.3 million and 18 cents per diluted share, up 23% and 29% respectively, compared to the prior year fiscal fourth quarter. Reconciliations between non-GAAP and their most comparable GAAP measures are included in our earnings release. We ended the year with $434.3 million in net debt and a leverage ratio of 6 times, a level we are comfortable with given our asset-light, highly franchised business model and our ability to quickly delever based on our EBITDA growth and strong cash flow generation. We are consistently evaluating the best use of capital and believe the return of capital is an important part of our commitment to our shareholders. In addition to our regular quarterly dividend, we paid a special dividend of $5 per share for a total dividend of $5.14 per share in the fourth quarter. Today, our board of directors announced a quarterly dividend of 14 cents per share of common stock payable to stockholders of record as of March 5th, 2021. This dividend, totaling approximately $4.2 million, will be paid on March 26, 2021. Since our IPO, we have returned an approximate $500 million to shareholders, and this return of capital demonstrates our confidence in our long-term outlook for our business. We will continue making the appropriate investments for the long-term growth of the brand and remain confident in our 3 to 5-year outlook. As noted in the release this morning, we are reaffirming our targets of mid-single-digit domestic same-store sales growth and 10% plus unit growth. As for 2021, we estimate reported SG&A to be between $76 and $78.5 million. This includes the following estimates for 2021. Brand partner convention of $2 million, which has an equal and offsetting amount recorded in revenue. Stock compensation expense of $9.7 to $10.2 million, and expenses associated with national advertising of $9.2 to $9.7 million, which also have an equal and offsetting amount recorded in revenue. Adjusting for these items, we estimate adjusted SG&A, a non-GAAP measure, to be between $55.1 and $56.6 million in 2021, compared to $50.9 million in 2020. I'd like to close by expressing my gratitude to all of our team members, our brand partners, and supplier partners for their entrepreneurial spirit and service-mindedness as we continue to navigate this challenging time. Our brand has demonstrated its strength and resiliency, and we look forward to continuing to execute against our growth strategies and deliver on our vision to become a top 10 global restaurant brand. With that, we're happy to take your questions. Operator, please open the lines for questions.
Thank you. And we will now begin the question and answer session. To ask a question, you may press star then 1 on your touch-tone phone. If you're using a speakerphone, please pick up your handset before pressing the keys. To withdraw your question, please press star then 2. Once again, that is star then 1 to ask a question. And at this time, we'll pause momentarily to assemble the roster. And the first question today will come from Jeffrey Bernstein with Barclays. Please go ahead.
Great. Thank you very much, and hope you guys are doing well down in Texas these days. I had one question and then one follow-up. The question regards to the comps as we go through 2021. I know you didn't give specific guidance to 21 alone, but needless to say, you're lapping a 25 to 30% comp in the middle of 21. So I think you made reference to confidence in sustaining positive comp growth off of those compares. I'm wondering whether you think that's reasonable as you move through the middle of the year. And obviously, if you don't want to offer any specific color, perhaps the drivers of the continued growth you mentioned, whether you could prioritize the national ads versus digital versus customer data, I think were the 3 kind of primary areas you mentioned. And then I had one follow-up.
Morning, Jeff, and thank you for the question as well as for your sentiment on what we're going through down here in Texas. It is cold. We did give the same guidance that we gave last year, as you may recall, which is a long-term outlook of mid-single-digit same-store sales growth over the next 3 to 5 years. We still feel very comfortable with that, as well as a 10% plus unit growth target. So reaffirming those metrics. As we think about 2021, yes, a couple things. We are, on a seasonal basis or quarterly basis, we certainly have some tougher compares in quarter 2 and quarter 3 than we do in 1 and 4. However, I think on a 2-year basis, that's probably the best way to think about what we're seeing in the comp and giving our confidence to being able to hit those long-term metrics that we guided to. As for the levers, there are a couple things that are important here. Number one, our average unit volume has now grown to $1.5 million across our domestic system, which is a game-changing type of AUV, which is fueling the development numbers that we are seeing, as well as our brand partners' interest in adding new restaurants to their portfolio. I would also call attention to the fact that our investment cost at $400,000 has remained relatively unchanged for almost 5 years. So the cash-on-cash returns are very, very good for our brand partners. As we look to this year, we were able to pull additional advertising dollars out of 2020 and put them into 2021. And as I mentioned on the call, we are applying those dollars in the key timeframes where, if you will, climbing that mountain is a little more difficult than the rest of the year. But we do have confidence in that. And then the other thing we noted, having now an over 60% digital business creates a lot of good information for us to leverage to interact and engage with our guests. A lot of the growth we saw this last year came from new guests to our system. And so therefore, we're going to be leveraging the investments we've made in a robust CRM platform to engage with those guests, generate those second, third, and fourth Wingstop occasions, and so on, and then convert them into heavy users in the future. And we think having that lever with more than 20 million guests in that system gives us even more confidence in our ability to continue to deliver positive same-store sales growth over the long haul.
Got it. And then my follow-up was just a comment you made in your prepared remarks on the unit growth for 21. Looks like you delivered 11% growth in 20, a very difficult year. And you talk about the pipeline growing. So I think you mentioned you were confident in slightly above the 10% long-term target. Just wondering whether there's any franchise pushback, because otherwise it would seem like there's opportunity to exceed that 10% by a fair amount, considering the real estate availability, the less competition. I'm just wondering, just want to clarify your comment around 2021 unit growth and what might limit that growth from being stronger.
Yeah, and I appreciate that question, Jeff. A couple of comments on that. Number one, the name of this game is about unit growth. Too often we get hung up on same-store sales. We look at sequential comps quarter to quarter. We think about how that impacts the unit economic model. And as I mentioned, ours is really strong and in a great position, and that is fueling our brand partners' demands for additional restaurants to add to their portfolios and grow their overall value. That manifested itself in the largest pipeline we've seen as a brand, and it also has manifested itself in an extraordinary fourth quarter development number. And as you know, early in the year, during the March and April timeframe, even into June, we had almost a stoppage of development. A lot of that pipeline is pushing forward. So if you add the new demand for new restaurant development, plus what was in the pipeline, plus what's in the pipeline going into this year, we did feel confident in stating that 10% plus is certainly our long-term algorithm. But if you look at what consensus estimates were for the year, I also commented on that as being a real decent benchmark for where we think our development potential is.
Great. Thank you.
And our next question will come from David Tarantino with Baird. Please go ahead.
Hi, good morning. Hope you both are doing well. My question, Charlie, I think you mentioned several same-store sales drivers for this year, but you didn't talk about your dining rooms reopening. So I wanted to ask about your approach there on when the dining rooms might reopen and if you've actually reopened any dining rooms and what you've seen since you've done that.
Good morning, David. The The reason we didn't put that in there is not because we don't think it has some impact. It has more to do with trying to figure out when that would actually happen. I think at the end of the day, a lot of our dine-in customers are also now carry-out customers with our brand. They've converted nicely to off-premise. And I think if you think of Wingstop as compared to perhaps any other brand in the space, our digital infrastructure allowed that conversion to be done with relatively little impact to our business. If anything, it helped us grow, right? And so we are being thoughtful about our approach. We certainly will prioritize and continue to prioritize the health and safety of our team members as well as our guests. But as we see the impact of the pandemic starting to subside, we would expect to open up those dining rooms. But I would not put it at the top of the list of what we think are the material impacts to our top line. It has more to do with continuing to generate strong advertising messages that cause people to consider Wingstop. Those people we're targeting, again, just as a reminder, tend to be those heavy QSR customers that we have not really had in our brand for a long time, and we're adding more and more of those with the levers we've pulled around delivery, digital, and our advertising. And we'll continue to do that throughout the year. And then once they come in, they are new guests. We want to re-engage them immediately and bring them back for that next occasion. So everything we can do to ensure a quality occasion for either delivery or carry-out is paramount. And then a re-engagement opportunity to bring them back, hopefully within the next month. That's our objective.
Got it. And then one follow-up, just a clarification. The 20 million people you have in your database is an impressive number given the scale of your brand. Does that include customers ordering through the third-party app? And I guess, Charlie, can you talk a little bit about kind of how you reach the customers that are coming in through the third-party app as opposed to the Wingstop app?
Yeah, it's a great question. Thank you. The answer is no. That database does not consist of people coming through the third-party app, and which is DoorDash, just to be clear. Our partnership with DoorDash affords us the opportunity to clearly understand who those guests are in terms of how they shop, who they are. We don't have specific information that would allow us to put them in our database to market directly to them, but indirectly, who they are has a lot to do with how we fashion our advertising approach and how we go market to them directly, either in the digital space or through some of our national advertising. So we believe that, yes, this is a really nice database. It's large. And it is adding new guests at a very high pace right now, given what we've experienced through the pandemic. So again, why it's important for us to engage quickly and efficiently with those guests to bring them back in for that next occasion.
Great. Thank you very much.
And our next question will come from John Glass with Morgan Stanley. Please go ahead.
Thanks. Good morning, all. So I also wanted to follow up just on the ad spend and how you think about that. Is there a way, Charlie, you can quantify the incremental spend? I think you said multi-million dollars, or maybe if you could express, like TRPs or however you want to think about ad spend increase versus 21, if you don't want to do dollars, maybe some other metric. And does that plan include like advertising funded by DoorDash, for example? Are you including or excluding, or do you have agreements with them as they think about promoting the brand on their own app as a way to also drive incremental sales?
Hi, John. Good morning. The best way to characterize it is more weeks and more TRPs, yes. We're not providing specifics on each of those, but you can rest assured there are more weeks and more TRPs from that spin. I think the other way I would characterize it is quality, which I mentioned in my comments. Given the fact that there's not a lot of new content and programming out there yet, we do believe that will come along. The one place we know people are living is in live sports, and so we have moved a lot of our inventory into places where we believe people will be consuming TV, which will be more live sports and premium sports at that. So that's another indication of how we're utilizing those incremental dollars effectively. As it relates to our partnerships, no, there is no money coming into the ad fund associated with our partnership with DoorDash. We may choose to invest in another free delivery program, or they may do that with us as they've done before. That's up in the air at this point. But again, $1.5 million average unit volumes, $400,000 investments fuel unit development, which is really where our focus remains in terms of the health and strength of the business.
So maybe then I could just follow up on that. Of the pipeline you've got now, can you just review the number of new franchisees have entered the system this past year versus the existing or legacy, percentage that are new markets versus existing markets? And are you thinking post-COVID now about a format shift, or as you think about how that evolves, are you going to see new formats in 21 that sort of focus on an all-digital footprint? That you've talked about that in the past, but if there's been any evolution in that thinking.
Yeah, the numbers remain consistent with prior years in that 80 to 90% of our total pipeline over those years has been from existing franchisees, and that remains consistent with what is going on. Last year, we've added very few net new franchisees to the system. Our existing brand partners are growing in size and scale, and they're able to take the strong cash returns they're generating and reinvest that back into the business. And so we expect that to continue. As it relates to format, or let me address first markets. Sorry. Very strong in our fortress markets, very consistent with what we've talked about in the past. We have about 25 key markets in the U.S. that we are working very diligently to establish a strong presence and fortress them, and that's working very well. So that usually makes up more than 75% of our total development. And then lastly, as it relates to new formats, we are up to 13 ghost kitchens across the planet for Wingstop. We're expanding them in the U.S. in key markets. Very early stages, but we like what they provide for us. Right now, it comes down to the same comment I made in prior quarters. We really want to understand the unit economic model. We want to understand whether it's a partner or build strategy. And we're taking our careful and thoughtful consideration into each of those decisions as we move forward, but expect us to continue to expand that footprint as well.
Great. Thank you so much.
And our next question will come from Andrew Charles with Cowen. Please go ahead.
Great, thanks, and hope you guys are staying safe in Dallas. I have one clarification and one question. So the clarification is that similar to a year ago, you provided the 3 to 5 year outlook for mid-single-digit comps and 10% plus store growth. Can you just remind us if this is an average over the 3 to 5 year time frame or an annual range you guys hold yourselves accountable to? And specifically, I totally get, obviously, the thought that obviously same-store sales are likely to grow next year, but can you talk about your level of confidence in delivering mid-single-digit comps in 2021?
Morning, Andrew, and thank you for the well wishes. All is well, lacking power and water, but we'll be fine. It's a good question because if it were an average, I would say all we got to do is deliver flat for the next few years and we'll hit the number, and I don't think that's what anybody's expecting of Wingstop, and it's not what we're expecting for ourselves. We do believe the brand has the potential over the 3 to 5 year time frame of delivering mid-single-digit comps. And hence why we reinforced that message this year, much as we did last year. Does it have the potential? Absolutely. We have to be diligent and thoughtful in pulling the levers. But again, I go back to the fact that this brand was so well positioned with our investments that we made in digital and delivery to prepare ourselves for this. We've only effectively been delivering food to our guests nationwide for a full year now. We believe there's growth opportunity there. We believe there's growth opportunity by way of our advertising and expanding that. I mean, we not only did we pull money in from last year, but we grew our sales by 30% which fuels a lot of dollars in the ad fund to really up our game dramatically. So there are plenty of levers there to be pulled to help continue the growth. And noting, of course, we're rolling over a big number, but we've done that many times in our 17-year history of positive same-store sales growth.
Thanks for that, Charlie. And then, Michael, question for you. How did the bone-in wing pricing mechanism impact 4Q results? Wing inflation was about 17.7%, and gross margins were down about 270 basis points. Can you say what the gross margin would have been without the pricing mechanism? And then looking ahead, what are your vendors saying about the outlook for bone-in wing prices as we look across 2021?
Yeah, Andrew, it's a fair question. Appreciate it. I think we did point out in our prepared remarks that the underlying Urner Barry was up 27%, and if you think about our bone-in wing mix of our COGS representing about 60% of mix, you can kind of work that math to get to a much lesser impact. And I think one thing that's really important to point out is the discipline we've had as a brand around taking strategic pricing twice a year. And if you look back to 2017, where we saw similar inflationary numbers in bone-in wings, and you can compare in our corporate store P&L as a proxy, the Q4 back then in 2017 compared to Q4 in 2020, and we're running a much lower food cost. So that's the combination of discipline around menu pricing as well as the pricing mechanism we have with our suppliers. But obviously that's one piece of it, but we've also been focused on making sure we're taking care of our team members in the restaurant as well, and making investments there. And so that's been a big priority for us for 2020, and remains that way for us as we go into 2021. But as far as the outlook, there's clearly a fair amount of uncertainty around reopenings and how overall supply will for the entire bird will play out. We've got a lot of mismatch, if you will, in the demand for the bird. Demand's really soft for the back half, and you've got some soft demand, low prices for breast meat right